This is the one that has saved us thousands of dollars. And I can't tell you how many people we've come across who don't know about this. And it's like, oh my gosh, like, if only you knew.
What's up, everybody? Welcome to Therapeutic Finance, where our goal here is to rehab our finances and hopefully inspire you to rehab yours. My name is Broderick.
And I'm Naja, and we are Therapeutic Finance. So basically, we decided to start this channel just to kind of document and share our experiences and our journey in rehabbing our finances.
So what we plan on doing is posting once every Friday because we deem Fridays
Finance Friday!
Exactly. We plan on taking you through our journey to financial freedom. This channel will also talk about a multitude of different financial topics, whether that be debt pay down, credit, or even investing. Today, though, we'll be talking about 5 things that you did not know about your student loans. Stay with us.
And be sure to stick around for number 5 because number 5 has saved us thousands of dollars.
Number 1.
So number 1, so first things first, you need to know the difference between a grant, a scholarship, and a loan. So basically your grants and your scholarships, that's all yours. That's all your money. You don't owe anything to anyone. Like, it's yours. That's what you want. Unfortunately, we are sometimes in situations where we need a little bit more than that. So we take out our loan.
So there's usually 2 types of loans that you can get. They can be private or they can be federal. The main difference between these 2 types of loans is the fact that private loans are given by different banks and financial institutions, whereas federal loans are given by the federal government. These both have different pros and cons that you have to weigh to see which is best for you, but most people prefer federal loans because of the fact that you have different perks that you would not get with private loans. Federal loans come with different perks that allow you to set up income-based repayment plans, and also they offer loan forgiveness in some situations. Now, when you're receiving your federal loans, they have 2 types of loans that come out. Some are subsidized, some are unsubsidized. You may hear that all the time and do not know what that means. Subsidized, when that loan is dispersed, no interest will be accrued over the lifetime of that loan until you enter into repayment. Unsubsidized, on the other hand, once that loan is dispersed to you, it will start accruing interest from day one. The second thing that you need to know is interest capitalization. So, remember those unsubsidized loans we talked about? Well, while you're in school, they'll be accruing interest, okay? Interest we don't want.
Yeah.
So, those loans are accruing interest while you're in school. Once you graduate, you get that diploma, you walk across that stage, and you start working, this is where they get you. They take all of the interest that has been accrued and they apply it to your principal. So now, instead of paying, say, $5 in interest every day, you're now paying $7 or $8 in interest every single day because they have now moved all of the interest that you owe onto the principal payment of your student loan.
Lower principal, lower interest rate.
Lower principal, lower interest rate.
Number 3. So the third thing we want to talk about is the fact that you have many different options when it comes to paying off your student loans. Some of those options include refinancing. So if you have a boatload of federal loans, what you can do is you can refinance them with a private company, that being a bank or another financial institution, into a lower interest rate. The theory behind this is if you're moving from, say, a 7 or 8% interest rate down to a 2 or 3% interest rate, then that can save you a lot of money over time. Another thing that you can do if you have federal loans is an income-based repayment plan. You would talk to your loan servicer about what's best for you. But the theory behind the income-based repayment plans is say, I can't afford to pay $1,800 a month towards my student loans. Well, you can talk with your loan servicer and they can set you up with a plan that allows you to pay maybe 10% of your take-home pay every month. Another thing you can do to pay off your loans is called loan consolidation. Say you have 10 different accounts and you can't keep up with putting the minimum on this account and that account and that account. Well, they have consolidation where you can put all of those into one big bucket and pay just one time. They will take all of those interest rates that you have from the smallest to biggest and kind of give you somewhere in the middle, okay? And allow you to pay one payment. And another option you have when you stick with federal loans is loan forgiveness. This is when the government decides that they will forgive you for your loans if you follow a strict set of rules over a period of time, a long period of time, making the minimum payments. With that, you want to talk to your loan servicer and make sure that you're doing everything that you need to do, because statistics are saying that only 1% of people in search of loan forgiveness is actually being forgiven for their loans. Number 4.
Okay, so number 4, we're going to talk about the student loan calculator. So this is a tool that you can find online, studentloans.gov, and basically you log in, put in your information. They ask you like certain questions like, what do you expect to make once you start entering the workforce, and just different questions that you have to answer. And based on that, they can tell you, they can calculate your loans and you know what your repayment will look like and what those different options will look like for you. So that's like really interesting to see, just to be in the mindset of like, what will I be paying when I have to pay this back, you know? So.
Yeah, it was really interesting to get something that actually tells you exactly, okay, this is what you should be expected to pay at that time. And if you were to enter into those repayment plans that we talked about, whether that's loan consolidation, an income-based repayment plan, or even the standard plan, it tells you what you should be expected to pay. So yeah, that's a really good site. Y'all should check that out.
Yeah, a really good tool to use. Chances are, well, you've definitely been on the site, but like, have you utilized the tool? So.
Number 5.
This is the one that has saved us thousands of dollars. And I can't tell you how many people we've come across who don't know about this. And it's like, oh my gosh, like, if only you knew. I mean, we could have put you on, but we didn't know. Okay.
So we're making it our mission to tell everybody, because this has helped us so much.
And like, it's not something that we just readily know. Like, through research, it's something that I came across. So
the more you know.
Yeah, seriously. So basically, this rule is extremely helpful to those who maybe have a job and want to pay towards their loans while they're in school, or even if you want to take out that full amount that they offer you and then want to pay some of that back. So basically, the rule is within 120 days of borrowing that money, whatever you pay towards your student loans is as if you never borrowed it. Essentially, there's no interest. You lower your principal and there's no interest gained on that loan within that 120 days. Figuring that out and knowing this was just like, because so many people, there's been people who've been saving this money to pay back later, and the best time is now.
It's right now.
So.
And the thing about it is, we want to pay towards our principal as much as possible. And when you're paying within that 120 days, all of your payments can and should go towards your principal. Sometimes you may have to call up your loan servicer, because some loan servicers are not as good as others.
Yeah, because like, I'm extremely happy with mine.
Yeah, me on the other
hand. It's a little text set, it's a little, you know.
Gets a little heated on the phone.
Yeah, some people have to, you know, mail in stuff, and I'm just clicking buttons on the screen. So.
But the fact of the matter is, this allows you to pay towards your principal now. We always want to pay towards our principal and not towards our interest. Paying towards our principal will lower our interest, and this allows us to do just that.
Lower principal, lower interest rate.
Lower principal, lower interest rate. So,
All right, guys, so that's it for our show today as we wrap up
Free. Oh, we have a Freestyle Friday as well, so Finance Friday.
Okay. Tell the people what they need to do.
Okay, so if you like what you see, you need to like and subscribe. We'll have new content every Friday, so be sure to tune in.
Next week, Freestyle Friday.
No. Okay.
Yeah, we freestyle.